I'm Ron DeLegge with ETF Guide, and pleased to be joined by Chris Hempstead with WallachBeth Capital. Chris, great to catch up with you.
Thanks for having me.
I want to talk about one of the things that a lot of ETF investors overlook, and that's the cost involved with bid-ask spreads. Talk about that.
So when we talk about bid-ask spreads, specifically with ETFs, because we're tracking an index level, we're tracking some other benchmark other than the ETF itself, we're looking for bid-ask spreads that are relevant to that underlying index level. In other words, minimal discount and minimal premium to what that index might be valued at any given time.
So can you give us some guesstimate as far as what's too wide and what's, you know,
it's
give us a rule of thumb.
Rule of thumb is what's relevant for any particular asset class. So if you're talking about large cap or mega cap stocks in an ETF, you're looking for bid-ask spreads that are very low single digit basis points wide. But if you're talking about something maybe a very difficult to trade emerging market product, maybe the appropriate bid-ask spread might be a little bit wider. So it's what's relevant for each particular asset class.
So let's talk about the flash crash in 2010. We saw a lot of market dislocations. How does that impact, obviously, the trading of ETFs? What do investors, what do people need to be aware of?
Yeah, I mean, one of the things, unfortunately, with ETFs about the flash crash is there's 1,500 ETFs. Maybe at the time there were roughly 1,400. Most ETFs don't have natural liquidity and deep asset base like the top 50 or top 100 ETFs might. So in times of uncertainty, when the markets get extremely volatile, one of the prudent moves of a market maker might be to take a step back, scale their machines back a little bit until they get a better idea of what's going on.
What about the potential for a flash crash type of event in the future? Is that something that could happen?
It certainly could happen again. There's no reason to think that if all the market makers were to turn off their machines in times of uncertainty in ETFs that don't have deep secondary market books, or what we call level 2, if the market makers were to walk away, then the spreads would widen and you would start to see what we call the stub quotes emerge. So in the future, could that happen again? Yeah, but they've put different mechanisms in place to make it a little less severe. There's thresholds that the exchanges have put in to absorb any kind of dislocation like that.
And from an investor's perspective, they need to be psychologically ready for these hiccups that come in the future?
Yeah, I mean, everyone should be prepared, whether you're a retail investor or whether you're an institutional investor or trader, to be aware of what levels you want to be trading at. So one of the things that we like to remind people of is the secondary markets give us comfort in the fact that there's bids and offers and there's liquidity and volume out there all day, every day. And that gives us a look into where other people think liquidity is. We strongly encourage people to understand where they want to be. What do they value their particular security or their particular asset at, so that they know what to do in the absence of all that other comforting information that's available to them every day.
That's great advice you just heard from Chris Hempstead with WallachBeth Capital. Thanks for joining us.